I am Dhana Pawar, and I'm very excited to be here this morning. We are here to discuss a topic that's very dear to my heart. So thank you again for everyone for being here. A little bit about myself. I run a company called Vera Tempo, where we work with startups and founders from ideation to launch. I also recently became a founding LP at a first of its kind fund called NA3 Futures Fund. And it's first of its kind because it's comprised of 100% South Asian women. And that's not the exciting part. The exciting part is 97% of our funders are first-time funders and never invested in anything before. So we really wanted to empower diversity, not just on the founding team in the companies we invest in, but also on the funder side. So you can imagine how excited I am to be here today. And now coming to the other part of my life, which is the Nasdaq Entrepreneurial Center. I have been on the advisory board of the center since the beginning, since 2014. And so very excited to see how far we've come. For those who don't know more about the center or much about the center, the Nasdaq Entrepreneurial Center is the leading nonprofit which is building a better path for entrepreneurs worldwide. We provide inclusion, access, and knowledge in entrepreneurship. And the best part is we've supported tens of thousands of entrepreneurs since 2014, half of whom are women, and over 66% are underrepresented founders. And we're only just getting started. So we aim to provide even more pathways for high talent, for underrepresented populations of entrepreneurs, to gain much needed access to entrepreneurial education while bringing new benchmarking to light, which is why I'm excited today to introduce the Venture Equity Project. The Venture Equity Project is a coalition of 10 leading academic institutions and global nonprofits supported by JP Morgan Chase, aiming to permanently improve the barriers that exist in the flow of capital to entrepreneurs of color. The initiative is focused on integrating data sets to better understand the market opportunity behind investing in diverse fund managers and entrepreneurs of color, as well as identifying points in the ecosystem where intervention is needed and where opportunities exist. And as part of the VEP project, the Nasdaq Center is committed to closing key data gaps, in convening key stakeholders to share best practices across the United States, United Kingdom, and Europe, and to highlight behavioral changes that can increase the flow of venture to entrepreneurs of color, which is why we're all here today, which brings us to today's meeting, and a special recognition and thanks to NVCA and PitchBook for hosting this very, very important conversation today. So after today's event, we will be sharing materials and research from all of our partners and panelists, including recent studies that the center has conducted with partners such as Extend Ventures, Penn State University, and Carnegie Mellon. We were looking at the flow of venture capital to underrepresented founders. So very excited, and hopefully you guys will benefit from that. And now, without further ado, we have a packed agenda. So excited to hear all the panelists. I cannot wait. So please join me in welcoming Emily Mentz, who is the ESG climate analyst on behalf of Nasdaq, where she's going to set the stage today and give you all an ESG market update. So welcome, and looking forward to the panel today. Thank you.
Awesome. It's great to be here. Happy Wednesday, everybody. My name is Emily Mentz. I'm a senior analyst on Nasdaq's ESG advisory team. First and foremost, I'd like to thank Selena and the Nasdaq Entrepreneurial Center for our partnership, and also for trusting me to give you all this market update this morning. So a little bit about me. Prior to Nasdaq, I worked at a $15 billion US equities fund based in London, and I was hired to integrate climate change considerations into their investment process. Before that, I worked at the Grantham Research Institute for Climate Change and the Environment, housed at the London School of Economics, where I also got my master's degree in environmental economics and climate change. So if you're sensing a theme with my background, you are right. About a year ago, Nasdaq asked if I would join the organization on the West Coast to start our climate change advising services for corporates. So over the last year, I've had the chance to talk to about hundreds of corporates on their concerns about climate change, upcoming regulation, pressure from investors, and what they're seeing in the market. So that will inform our discussion for the next 8 minutes. I had some slides, but I'm just going to keep going. So when I attend events like these, the first question I usually get asked when I say I'm from Nasdaq is, am I a reporter? So just to clarify, our ESG advisory and climate advisory team sits within Nasdaq's corporate solutions business, which is one of our 4 reportable business segments. And the purpose of our corporate solutions business unit is to provide clients with everything they need to be a successful public company. What's interesting about my team specifically on ESG advisory is over the last year, we've had increasing demand from private companies, mostly because their investors, such as the people in this room, are requesting that they implement ESG programs. There we go. So today I thought it'd be helpful to touch on 3 main areas. First, ESG capital and more qualitative trends, so looking at some data. Second, regulatory developments. I know most people are not like me and don't enjoy talking about regulation forever, but we are just at a really interesting time in the ESG market right now. And finally, closing out with some of Nasdaq's initiatives related to ESG, even though we made the front page of the Financial Times this morning. So because our customers are usually corporate clients, we are continuously monitoring mutual fund filings, and this database is updated every day. So as of Friday, when I made this slide, funds managed in line with ESG strategies totaled $3.1 trillion. So just for reference, according to McKinsey, venture capital of the last year AUM totaled about 1.7 trillion, and global AUM is about 112 trillion. So these 3 breakdowns I thought were interesting to the venture capital community for a few reasons. On the bottom, we can see that actively managed ESG investments comprise 5 times the amount of passively managed ESG investments. So actively managed investments are usually viewed more favorably from an ESG perspective because they have longer holding periods and the managers are more involved in their underlying investment. So you can argue that venture capital, private capital, you're perhaps the most active managers that there are. So there's huge upside opportunity here for implementing ESG-related programs because the reality is you're probably already doing some of this. Moving clockwise, next breakdown shows different ESG-related strategies. So there's been a lot of news flow lately about accusing BlackRock, for example, of sacrificing financial returns in favor of woke agendas. And I just want to hammer home this pie chart right here because the majority of ESG-related investments are managed using ESG integrated strategies. And having worked at an ESG integrated manager myself, I can tell you that financial returns are not compromised for the sake of woke agendas. It means that non-financial factors are considered in tandem with financial factors for a longer return period. Moving clockwise again, the sector breakdown is also particularly interesting. Unsurprisingly, technology stocks have the most ESG capital compared to other sectors. Why is this? A few main reasons come to mind. First, they're capital light businesses, which means that they naturally have a lower environmental footprint, so they have a head start from the get-go. Second, they're usually higher margin, which means they have more resources to invest in ESG initiatives and also report on them. And finally, as I'm sure this community is well aware, their services and products have the potential to improve society in a lot of ways. Zooming out a second and looking at some more qualitative ESG trends that have emerged for last year, climate, of course, I am biased, but it's almost its own investment strategy now. It's inherently more quantitative, more rigorous, more scientific, and more complex than a lot of other ESG topics. Diversity, this is an issue that is very close to the heart of NASDAQ, to our CEO, to the center here, to me personally, and it's also just good business. So there's research that shows that diverse boards they're less likely to commit financial crime and business ethics related risks. And diverse employees are more likely to generate more innovation. We're also seeing more demand for ESG practices from stakeholder groups beyond just investors. This includes employees and also customers. And finally, this last part will be the focus of the rest of our event today, but ESG trends in private capital is on the rise. Switching gears slightly into regulation. So in April, I hunkered down and I read all 500 pages of the SEC's climate proposal. It's not pretty. It's not pretty. And they're proposing, as it's written, to require all companies that want to go public to also disclose all the regulations. So just for some background, and again, I'm happy to talk about Nasdaq's position on this more later. That's the main reason that our comment to the SEC encouraged some adjustments to the rule, was because of the IPO market. If your portfolio companies are not looking to go public right now, which is the likely, in all likelihood, what is happening, there's another way that this could influence private companies, and this is through the Scope 3 emissions disclosure requirement for large public companies. So the more large public companies that are required to disclose their Scope 3 emissions, this is emissions across their value chain, so they will likely be going to all of their suppliers and customers for their Scope 1 and 2 emissions. So this is going to create more pressure from other aspects for everyone in the economy to start measuring their emissions. So taking a quick look at Europe, and I know they seem far away, and everyone says they're always far ahead, but having worked there for last year before NASDAQ, I didn't realize how far ahead they were. So there's a regulation called the Sustainable Finance Disclosure Regulation, SFDR, and it applies to all asset classes. So including private funds. If you want to say that your fund is sustainable in any way, you have to self-identify as either an Article 8 fund or an Article 9 fund, meaning Article 8 funds promote environmental and social characteristics, and Article 9 funds have a sustainable investment objective. So most funds in the EU, as you can see here, are classifying as Article 8, and most ESG capital is also in Europe. So what does this mean? There's also this regulation called the EU taxonomy, which is basically a definition for classifying sustainable investment activities. And starting in January 2023, as part of the SFDR, all funds that have self-identified as Article 8 or Article 9 will have to disclose the proportion of their assets that align with the EU taxonomy, so that are actually undertaking sustainable economic activities. In January 2024, all financial market participants in Europe will have to disclose this. So this is huge. And again, when I was working in Europe, I thought, I wish the US would, just catch up a tiny bit, just be a tiny bit less embarrassing. But sure enough, as I'm sure you're all aware, recently we did have a significant amount of climate-related legislation passed. And this is going to change the landscape for climate tech and all the technologies you see here by significantly reducing costs. So once again, we're at a really interesting point in the regulatory landscape. And I just want to close out by touching on some of the things that NASDAQ's doing before I turn it over to Hillary Wick from PitchBook. In 2020, NASDAQ launched our Purpose Initiative, where we basically rewrote our business's purpose to champion inclusive growth and prosperity. The NASDAQ Foundation and the Nasdaq Entrepreneurial Center are a huge part of that. As of August 8th, our board diversity rule is now in effect. So all public companies have to put on their website a board diversity matrix and explain why or why not they have diversity in their boards. And finally, again, I just want to close by acknowledging climate change and say that NASDAQ recognizes that it is an incredibly complex issue that is going to require a lot of changes on the behalf of companies and investors. And if you would like to learn more about what we're doing to help both parties involved, I would love, love, love to come talk to you.
Hi, I'm Hillary Wick. I'm at PitchBook. I'm in our institutional research group. I joined, though, after 25 years of being an institutional limited partner, so that's the view that I tend to bring to PitchBook, is sort of between the LPs and GPs. But I also cover sustainable investment topics. And for the third year in a row this year, oh, mic's working now. Third year in a row, I've run this sustainable investment survey, which is talking to LPs and GPs, as well as their service providers that work with them. And as a sneak peek, I'm actually writing that report right now, but as a sneak peek for the VC responses from that survey, I thought I'd highlight some of those today to show you how people are thinking in the industry. So first, this survey ran in July of this year. We had about 251 VC respondents. 55% were from North America, so actually a pretty good group. I don't know if you guys have ever tried to run an industry survey, but we used to be really happy with 100 responses for the whole survey, and now we have 251 that were just VCs that started the survey at least. You'll see that only about 30% of the VCs started doing anything in the sustainable investing landscape more than 5 years ago. So it's still a pretty nascent landscape where people are still figuring it out. This is asking, did your firm utilize an ESG risk factor framework when deciding to invest in a company? So the next question is going to be managing your company. This is investing in a company. There's still a sizable number that are saying no, but 55% have at least implemented something along the lines of an ESG framework for assessing potential investments. And this is for monitoring portfolio companies. There's a little fewer, only about 49% have implemented an ESG framework for managing and monitoring their portfolio holdings. And I should mention that these slides, if you go to the QR code and eventually you'll get an email after this event, you'll get these slides. So I know I'm going through them pretty quick, but yes, so you will get a copy that you can look at at your leisure. The next one is, do your portfolio companies utilize a standard or custom framework to measure and report on their financially material ESG risk factors? My question is, are we getting convergence yet? The answer is no. You'll see that almost 50% are still using a custom methodology. I personally feel like I've witnessed some convergence, and we'll talk about that a little bit on the panel that I'm about to conduct, but there's still a pretty wide variety of standards being used or people giving up and just creating something for themselves. This is a question where I ask people to put themselves on a spectrum between performance and sustainability. Again, this was just our VC respondents, and you'll see that it's kind of across the map. Some people do think that performance is the only thing that matters. Some people think sustainability is the only thing that matters. There's a pretty good clump in the middle. In the survey report that I'll put out, we'll give you the medians, and you can see that Europe, for example, might be a little closer to sustainability, and LPs are much closer on the performance side, for example. And this is asking VCs, have their LPs or prospective LPs been expressing increased interest? So this is why people in VC are asking and trying to figure this out. Almost 60% of LPs have been asking and increasing their asks when it comes to ESG in the last 3 years. And then unlike in the GFC, we ask a question each year asking sort of, are you backing off or sticking with your ESG programs? I would say during the global financial crisis, a lot of people said, this isn't nice to have. We've got to figure out what's going on in our portfolio. We're seeing people really standing firm. We've asked this question the last 3 years during the pandemic and now with the war in Ukraine. More than 70% are saying they're either staying the same, and then another good hunk are actually increasing their efforts. This year in the open responses, a lot of people mentioned Ukraine and the energy crisis as a reason to increase their focus on ESG. And then just providing a couple of resources. These were open-ended responses from people in the VC community, ones that they said that they are either endorsing or members of, so that's the list on the left, as well as what they're using to stay abreast on ESG and sustainable investment development. So these might be some sources if you're trying to figure out where to find information on the topic. And then just a little bit on what PitchBook's been doing in sustainable investing. So my colleague who is here near the front row, Annika, wrote a paper, I don't remember the official title, but it was essentially talking about the philosophies of ESG. There isn't one definition of ESG. Some people think it just means a perfectly pure portfolio, and it's all about environment, and other people think of it as a risk factor framework that affects all sorts of areas of your business. And we're not, and I don't think anybody here in the room is in the business of trying to define that, but what could really help keep people from throwing around accusations of greenwashing is if they maybe understood there are different philosophies, and maybe just find the partners that, align with what you're trying to do rather than just trying to badmouth the whole industry. We also have added impact funds data to the platform. So we've now got 2,300 funds tagged on our platform for seeking impact investments. And we've added a subcategory of impact using the IRIS Plus framework so that if you're interested, for example, in just affordable housing, you can look through our real estate list of impact funds and not have to look through all 2,300 funds on the platform. And then, as I mentioned, we do an annual sustainable investment survey. That should be coming out end of September. So you got a little bit of a sneak peek today. And then these are some pieces. You'll be able to link through to it if you go to the QR code that's on the walls throughout this room today. So Annika's note is in there. Last year's Sustainable Investment Survey. We partner with NVCA every quarter on a venture monitor, which is everything we can think of to talk about related to venture capital. And then I wrote a piece, especially for the emerging managers in the room, that's talking about it's called PitchBook's Guide to Your Pitch, but that came from my experience as an institutional investor and the kind of things and questions they'll ask and things you should be prepared to talk about before you get into the room with an LP. So that's the introductory comments. If we want to bring my panel up, and we'll get started talking about some other ESG topics. Thanks for joining me. I'll give really brief introductions. You guys can always go to LinkedIn and find out everybody's full history. To my immediate left, we have James Joaquin. He is a co-founder and managing director at Obvious Ventures. The firm was founded in 2014. The firm coined the term world positive to describe their VC investment lens, focusing particularly on sustainable systems, healthy living, and people power. To his left, we have Tracy Barba, who is the executive director of ESG for VC. She is leading this group and trying to streamline the getting started process for VCs. She joined after a long career in VC and impact investing, most recently at 500 Global. And then finally, we have David York, a founder and managing director at Top Tier Capital Partners. San Francisco based, but they have offices also in Boston and London, a VC fund of funds investing in primary commitments, secondaries, and co-investments. They were founded in 2011 as a spin out from Paul Capital, which is actually where we first met when I was an investor at Paul Capital way back in the day. So I thought we'd start off a little bit with level setting. And as I said in my opening remarks, ESG is not just one thing. To some, it's a perfectly pure portfolio. For others, it's a framework to identify and mitigate risks and opportunities. Can we start with each of you describing in a quick elevator pitch what ESG means to you and your organization? And we'll start with you, James.
Great. Thank you, Hillary. Let's see if my microphone is powered. Testing, 1, 2, 3.
Talk louder.
I can just project. There we go. There we go. Okay. Good morning, everyone. Quickly, for us at Obvious, we've been on an 8-year journey starting with this idea of world positive investing. So we have an ESG advantage in that we're only investing in companies that are generating positive environmental or social benefits. And we have, really evolved our thinking about ESG for venture capital as flipping the model from public equities, where ESG was a risk framework. You talked about that, Hillary. And this idea that we can actually look at what are the potential positive environmental and social impacts. That's the work that we do. We call it ESG intention. We actually score each investment opportunity in these 9 areas. And we published a piece about this that'll be on the resource page if you want to learn more about that.
Awesome. How about you, Tracy?
So I'll talk a little bit about how we viewed from a 500 global perspective. So 500 is an accelerator and also does follow-on investments around the world. And the way that we use ESG or think about ESG is as a risk mitigation and also value creation opportunities. So we screen companies when we're first making investments. And the idea there, similar to James, is to look at intention, to look at what kinds of policies and processes companies are thinking about from the very beginning. And then we see our job as trying to guide them on that process of figuring out when to integrate environmental, social, and governance considerations into their companies. So that's how we think about it.
Great. And David, to repeat the questions, it's been a little while. What's ESG mean to your company?
Am I on? Here we go. Yeah, great. So just a little background on us and then how we get involved with ESG, and it little dovetails what Emily was talking about earlier at Nasdaq. So our firm has been essentially investing in venture funds for more than 20 years. And if you sort of dial up 40,000 feet and think about venture capital, everything you do, no offense, James, is trying to improve the world, right? So it's every company you start has that sort of bias if you think about it. And so ESG has been sort of part of the vocabulary of our fund activity, really driven by our investors, which is what Emily was talking to earlier, is the investors are actually looking for capital to have a conscience. And that about half our investment capital comes out of Europe. And so the Europeans were pretty fired up about it. On one hand, on the other hand, I would say 90% of the Europeans still don't have a policy at the capital level, although their boards are fired up about it. So everybody's still in this sort of journey to figure out what these three letters mean. And there's actually some chatter here in the US about getting rid of the three letters and coming up with a better description. Because it's now become a marketing term, which now the SEC is fired up about because they don't want you to market a fund off of this characteristic. They actually want to use your performance and those sorts of things. What I do see happening in our world is that the investor base at the end, the capital source, if you will, is going to drive this, not the investors, not the managers and or the entrepreneurs, because at a high level, again, all of these people are thinking they're fixing the world every time they put money to work. Most of us aren't going to fund slavery organizations or gun organizations or things of that nature. Most of us are worried about diversity. So it's kind of in our DNA, especially at the venture capital level, to have all that stuff. So we kind of think this whole notion of tracking it is a little bit of a pain in the ass, but it's coming. And so I guess I want you, as you come out of this meeting today, you guys have got to get your head around the fact you're going to have to think about this. I do think it's going to work its way into the framework of how money is allocated and how money is invested. So 5 or 6 years from now, we're all going to look like James. I have 5 or 6 things that we think about as it relates to making. No, to his credit, he started a firm. He and I know each other for quite some time. And it was all about this 10 years ago, and which we thought was charming. He was going to do, biodegradable soap. It was a good thing. His wife has a wonderful company that does that. So anyway, bottom line is that's where the world's headed. And so I do think money is going to have a conscience. It's just, and it's going to be driven by the capital source versus the invested source. Anyway, for what it's worth, that's and I have some other things I can talk about.
Investment had a huge exit to Unilever, by the way.
God bless. Good things. He's got a new house. Anyway.
Strong venture returns there.
So I think you set me up nicely, David, for the next question. Is I feel like one of the VC stumbling blocks has been that early stage companies people feel should just focus on very clear business metrics and not be distracted by this ESG stuff. What can fund managers do to get portfolio companies off to a good start, so they don't have to retrofit their businesses when they've reached sufficient scale to be more thoughtful? What's reasonable to ask of these startup businesses? And I don't always want to go straight down the line, but I feel like our venture capitalists should start on this one if you want, James.
Happy to start. Topic near and dear to my heart. What we try to do is not be overly prescriptive with our founders. David, you spoke to this, that taking public equities measurement and trying to apply that to 2 scientists with a PowerPoint is a really bad idea. And we think, a lot of the rigorous ESG measurement, which is really important for larger companies, is inappropriate for early stage. And one of the things we've done over the last 8 years is we've tested different ESG or impact measurement frameworks. We did the B impact assessment. Obvious Ventures is a certified B Corp ourselves. And we tested that with our founders. And what we found is that for companies at a certain stage, B Corp certification is great, especially if you're a consumer brand. It actually helps you acquire customers. It helps with employee recruiting and retention, but it's inappropriate for a really small company. There's not enough to measure. And so instead we focus on this idea of intention. 5 years ago, we published something called the World Positive Term Sheet. That was about us asking our founders as early as the term sheet to say, hey, write down your mission, your purpose, your values. Let's make sure that you're aligned with your investors. Why are you building this company? And I've been on enough boards to see where that misalignment causes huge problems. You don't want a founder saying, well, we're going to get our product cradle to cradle certified to remove toxicity, and an investor saying, well, wait a minute, you're taking away 10 bips of gross margin. I don't want to do that. That would be a misalignment of purpose and values. So we try to just capture that and make sure that everybody's aligned. That's where we started. And the new thing that we're doing is really just internally, we've come up with a lightweight kind of ESG rubric that we use just to score that intent of the company. What will in the future, what will the environmental benefits be, or the benefits to society, or the intention of the founders to build a diverse team and board and to practice good governance. And we try to actually investigate that early, and that's part of our investment process.
Okay, so Tracy, David set us up again. Many VCs know they need to do something. in ESG to meet the demands from LPs, but they're paralyzed by what seems like an endless number of thought pieces, organizations, and frameworks that can disagree with each other. Not to mention that every LP seems to have a different idea of what they want. What sorts of things can a VC do to get started integrating ESG practices into their business? And what might they already be doing that they don't realize from an ESG perspective?
Sure. So I think to get started, one thing we did at 500 was bring in outside resources to kind of just help us level set on what we're already doing and what sort of meets certain criteria, and then sort of develop a roadmap on where we can go from there. So we didn't take the approach that we need to be sort of best in class to begin with. As was mentioned, I think with a lot of companies, it is a matter of figuring out where they are in their journey and then helping guide them in that process and sort of help them to realize their intention. So I think that one, understanding what you're already doing, and there's a lot of stuff. So it took, 500 probably, it took us 4 to 6 months to actually implement ESG policy. I've now done it for 5 funds and evaluated over 250 companies based on the framework that I developed for them. And I would say that that process that we went through was one, there are a number of partners who are kind of like, not sure, like, do we need to add this to the investment process? It's going to add more questions. We don't really want to put this onto the portfolio companies. But what I found when talking to the portfolio companies is they want to know how to do a lot of this. They want to understand how they can do more diverse sourcing. They want to have resources. So, and there was a lot of that we were already doing that we had not realized. And so it was a matter of us kind of putting our heads together, creating a task force, sort of bringing different stakeholders from within the organization and external to the organization to identify what areas are we really strong in, where do we need to improve, and then how do we build a roadmap so that we do it over several years. It's not something that's going to happen overnight. So,
excellent. David, as someone making commitments to funds, how do you approach ESG with GPs that are either ignorant or resistant to the idea? And have those conversations gotten less necessary because people get it?
Well, let me answer your prior question, and I'll answer that one. So my advice is to keep your methodology simple and iterate, because the whole community's iterating. So don't lose sleep over not being like definitive. And some of the easy areas to work on as it relates to ESG is really around diversity, especially with your entrepreneurs. You can put a Rooney Rule of hiring in place. That's what we've done at our firm. And that's just a super easy thing to do. It doesn't mean you can still have a whole bunch of white guys. That's okay. But at least if you have a Rooney Rule in place, it starts to make you think differently. Those sorts of things are where I think you can begin as you get going. What we did, so we're a UN PRI signatory in addition to everything else. And so one of the things that required is we do get a policy in place. My neighbor here is also a UN PRI signatory as well. If I remember correctly, 500 is, all right? Are you? Oh, you guys? Oh, I thought, okay. You're much further along than most of the people on that. We, to do that, came up with a questionnaire that we give our managers. It's very light touch. And one of the big questions is, do they care? And do they have a policy? And we started doing, so we became a signatory 2 summers ago, and we started doing this with our newest funds. And so it's on the end is 25, but 67% of the people that we've invested with thus far have a policy. And so it's becoming more and more commonplace, getting back to what you were referencing. Again, I think keeping it simple as you get going is the best way to get going, and not lose sleep over having the absolute answer. And you want to say something?
Yeah,
I love that. I just wanted to add on the kind of
Sure.
tips for getting started. An early stage startup can get to work on a simple ESG policy. I think that's a great idea. And, we heard from Emily that you're going to need that when you're a big public company. So the sooner you get started, the better. The other hack I forgot to mention is that we encourage founders when you're first starting a startup to incorporate as a Delaware Public Benefit Corp, PBC, instead of a Delaware C Corp. It's an identical structure from a taxation point of view, but it gives you, the founders, this added benefit that you can consider all stakeholders. You don't have to just consider your shareholders. So if you want to make a decision for your employees or for your local community, you can incorporate that into your governance, and you have some protection to do that as a PBC.
Interesting. Good point.
I would also just add a quick note for companies. There are a number of, both on the software side of things, but a number of service providers that are emerging that we've been working with, that we've provided to our portfolio companies. We do a lot of training and workshops, probably 30 plus over the last 2 years. And so there are service providers at good price points that will help you get started in a very simple way, but help you to track and manage and evolve your sort of ESG over time, both for the fund manager and also for the companies.
Yeah, let me plug one more thing, just as it relates to the PRI and the NVCA. I just recently stepped down from the board at the NVCA, but I'm sort of the token ESG person that was on the board, and so I've been active with the PRI. They've been doing due diligence questionnaires as sort of frameworks for folks. They've done it for the buyout community. They've done it for the hedge fund community. They're just right now, we're finishing it up for the venture capital community. And so as managers, you'll have an opportunity to actually have a draft of a due diligence questionnaire that'll also help you think about how you want to think about ESG going forward.
Actually, I thought I'd do a quick break. Just raise of hands. I'm going to ask if you consider yourself an allocator, a fund manager, or a company, just because I'm curious who our audience is and if we're speaking to you. So who considers themselves an allocator? And maybe everybody put your heads down so they don't all try to sell to you right now. All right, got a couple allocators. Where are we at on fund managers? Okay, and then venture-backed companies or other types of companies? Okay, so a lot of fund managers. Good to know. Just wasn't totally sure who our audience was. So one question to be a little bit current, I guess, is we're seeing major efforts to politicize ESG this year, particularly states banning investments in ESG strategies. I don't know what they think that means. My survey says that lots of LPs are still interested, but is this becoming something we can't talk about openly for fear of setting somebody off? Anybody want to start on that question?
I mean, I'm not run across it. I mean, the SEC is worried about it from a marketing point of view, and he's a political animal, so he's politicizing it. But the rest of, I haven't run across it in our public pension fund LPs at all. So for what it's worth.
Okay.
I think ultimately performance is going to tell the story. And Emily touched on this. There's what I believe a false mythology that somehow if you're building or investing in a company that's doing good, that you're somehow concessionary or you're compromising profits. And our thesis is the opposite. We think these companies are actually going to outperform. They're going to attract and retain better human capital. And it'll have an easier time getting customers and all of those things. But ultimately, we'll get performance data on this. And there's firms like Generation IM, and they've been doing this forever. They've been outperforming the market with a very authentic sustainability carbon mitigation strategy. We'll build more of these case studies, including in early stage venture capital. And ultimately, we just need to show that it's good for business. It's good for your fund. It's good for your startup. That's going to be the ultimate motivator for people to really adopt these things.
That said, you don't use the terms ESG and impact because you were worried about misperceptions.
Well, we do use ESG.
You do now, okay.
But when we started Obvious Ventures, we made a very specific decision to ban the I word. So we said we are not going to describe ourselves as an impact investor. We're not going to use that in our marketing language to LPs or to founders. LPs meaning limited partners. And the reason we did that is, 8-9 years ago, when we started, impact investing had a very, very strong perception as being concessionary. And impact investing it's an important asset class, and it's a continuum. There's different styles. Some of those styles are specifically impact focused with sub-market returns. And so we needed to really differentiate from that. That's why we initially coined the term world positive. Now we're talking about ESG as, again, this ESG intention is to capture those positive externalities that will happen in the future. And that's our world positive roots.
Gotcha. One data point I was going to add to this politicization of ESG is in my survey 2 years ago, which was the first year I ran it, there was one person who said this is all political BS. Last year there were 5. This year, 45. So the numbers are growing of people who, in a survey about ESG and sustainable investing, felt the need to finish the survey and type in answers that express their anger at this whole movement. So it's definitely there. David, sounds like you're lucky you're not getting some of those talking to you right now. A toss-up, I guess, given that VC investors are usually minority investors, how receptive have portfolio companies and your fellow investors been to your ideas to implement ESG in portfolios? What's the conversation like, but you don't have as much control over your investment as maybe a PE firm would?
I think for us, it's sort of mixed. Some founders see it as important and they want to integrate a lot of the ESG components, whether it's measuring their carbon footprint or looking at their diversity, but they just don't know how or when to do it. And so that becomes the sort of crux of the conversation that we have with them is about, what it means and at what stage do you move from 2 to 3 people to 6 people, when do cultures get set? And they seem quite receptive, I would say, overall to wanting. Nobody says, no, we don't want to do this. It's just a question of how and when we do it. I think that in the Valley in particular, what we see from founders is we just did a founders retreat where the main topic that they wanted to cover was ethical tech. So looking at unintended consequences of tech and trying to develop frameworks for them to be able to go through a checklist when they're doing product development. I think that's becoming more and more sort of part of the conversation. And that's something they're quite interested in, that I see that they're very interested in doing. In terms of, the metrics, so my thinking around the theory of change for our companies was we, asked them a series of questions really to gauge where they are in their journey, their intention. We then provide them with a bunch of training and tools and guidance and consultants and networks, and then we measure them a year later to kind of see. We ask them the same set of questions. I had to make sure the survey took no more than 10 minutes. So I think they're, so far so good. We still have to chase quite a few of them to be responsive to it. It remains to be seen whether or not that's a good indicator, but I'm hoping the third year of data will give me more insights about where to adjust those kinds of things. And I think also it's not so much a question of the data that we collect. It's more about what do we do with that data? Like at what point do we require the companies? And that is a discussion I think that companies are sort of now waking up to. Like, when is this going to be a requirement that we have to do? That's the other question we get asked quite a lot.
I can share a quick story from the front lines. Back in 2017, I led the seed round in a startup called Incredible Health with this talented and very diverse founding team. And Iman Abu Zaid, the CEO, she had got her MD in London and then came to the States, got her MBA and worked at a health tech startup and was starting this company to solve the nursing shortage in the United States. And I asked her to fill out our World Positive term sheet, which again is very lightweight, but it's about codifying your purpose and your values or your philosophies, the things that are going to become part of the culture of your company. And she was resistant. She was like, James, you're crazy. I have so much to do. I have to recruit a founding team. I got to close the rest of the seed round. I've got to fight off other startup competitors. But, I kind of just gently pressed her on this, and she and her co-founder took the time to do it. And then she reflected back that it was one of the most important things that she did early on. It helped them define the purpose of this company as really helping nurses find and do their best work. That informed everything from their product roadmap, what they built in engineering, how they pitched their service to hospital systems. And the company's now a very successful, very valuable growth stage company. But that exercise really early on was something we pushed her to do, and she thanked us later.
Yeah, I think that was actually a conversation Tracy and I had 2 years ago that lit a light bulb for me. It's way easier to do it up front than to try to retrofit your company. I think most of us have probably worked at companies where the executive leadership team was filled with, shall we say, a non-diverse group of people, and retrofitting it, they're not going to fire half of them to be diverse. They're going to put in a policy that maybe 20 years from now will get you there. But it's a lot easier if you start in a good place than trying to retrofit your company.
And also I think from a good point is that it often opens up the thinking around the market opportunity that they wouldn't have considered in some cases. So we see that happening as well.
I have no idea where we're at on time. I believe we have time for a question or two, however. And it's a small enough room. Feel free to raise your hand and shout it out. I think we might have some mics. Anybody have questions for the panel? Quiet group today.
We've got a hand.
There's one up front.
Now we have two
please.
hands, okay?
Hi, Claire Ruby. I'm a consultant in HG. I'm curious as to when we start shifting from intention to outcomes, because I think there's a point at which it's not enough, right? To say, like, we think this is important, it's part of how we do business. Like, if there's no quantitative anything tracking it, it's like the equivalent of greenwashing from a company point of view. Does that match to company maturity? Like, what is that?
I 100% agree. I think the question was, when do we move from intention to actual measurement of outcomes? Its intention is maybe necessary, but not sufficient. We have to actually see that there are results. Is that a fair restatement? And the piece that we published this morning called the ESG term sheet talks about the ESG journey from venture capital to growth equity to all the way out to public markets. And it moves from intention to measurement and public reporting. At the simplest level, we think those are three big stages. And measurement tends to happen when a company is post-revenue, when your product or service is in market, right? If you're two scientists starting an electric bus company and you have just a PowerPoint plan, well, you have a lot of intention to reduce greenhouse gases with your electric buses, but you have nothing to measure. And then maybe in the first 4 years of your company, you're building a factory. You're generating actually a lot of greenhouse gases. You're going to score negatively if you just put a narrow measurement lens. But ultimately, when you've put 600 electric buses on the road and they've replaced diesel buses, you're going to have an ESG report that's going to be really, really impactful, right? So it's a journey, and you have to find the right level of measurement at the right stage of the company.
I agree. I think the question of, because I went from traditional venture into impact investing for about a decade and worked on social impact bonds where the payments are outcomes based. I think, and now having worked on the ESG side with early stage ventures, the outcomes piece, we're still quite a ways away from understanding that. That takes several years for us to even begin to understand like what we're doing now and what we're requiring and whether or not that's going to have a positive outcome. I think what I described, what we tried to do very early on is just gauge where they are in their process, and then has that changed by providing them with, counsel and guidance and things. And what I found was that it depends on where they're at, whether they are generating revenue, whether they aren't. And so I think we're learning a little bit of that, and that will continue to inform the field. So to the earlier point about keeping it simple and iterate, I think that's something that we know how to do very well in terms of venture capital in the Valley. And I think that's the kind of approach that's needed in order to start to build out the field.
Yeah, I want to say a couple things. My quick takeaway on all that, where are we in our life cycle of this? It's very similar to a startup. I think we're about halfway. We're kind of 4 to 5 years in. You might think that's short, but the governments have just showed up. We have the European Union requiring capital to be raised in the marketplace with requiring a policy. If you think about the life cycle of a company, that's going to take 6 years to see impact. So we're kind of median halfway through this journey. We're starting to see outcomes. I mean, James was way ahead, to his credit, and there are several other firms that are like his, but not many. And they're starting to generate actually credible outcomes, to his credit. So anyway, so it's still a little bit early, but it's starting to sort of, I believe, show some traction.
Yes. Here comes a mic for you.
And also co-founded an initiative called Venture ESG. We know Tracy very well. Thanks all. I had a couple of questions. So we tend to talk about ESG mainly as it relates to the investment process and how it affects portfolio companies. And we kind of don't talk about how it affects fund managers and the way that they operate and run their funds, which we think is pretty important. You've got to walk the walk before you ask things of your company. So curious about how you're approaching that. But also, David, sounds like you guys are very ahead of the pack when it comes to ESG.
Trying to survive.
How are you actually kind of supporting your portfolio fund managers? You know, it's not just a question of having an ESG DDQ. It's about building long-term capacity within these funds and actually educating investment teams and to know how to look out for ESG risks and value opportunities and how to support their companies. So from an LP perspective, because you said it's going to come from the LPs down, I'm curious about how you're actually going about that.
So it's like I said earlier. So we spend a lot of time with this due diligence questionnaire on the funds we take to committee, kind of educating. But there's, for better or for worse, because we're trying to get allocation, there's not a lot of teeth in what we're doing. It's really trying to educate. My sense is in the ecosystem, we're kind of, if you like baseball or cricket, you're in the first game of a tournament. You know, we're in the second or third inning as far as getting this sort of into the vocabulary. We have not turned anything off because they don't necessarily make us happy. But my sense is probably within the next couple of years that'll become the case. And some of it, again, gets back to the regulatory regime. Yes, what the SEC is doing, something will stick there because it is politically sort of neutral, if you will, for most of the country. And what definitely is going on in Europe is absolute sticking. So you're going to see, and then Asia is yet to really make this a thing, but you know the Chinese government is adamant to try and fix up their climate. So I think it ultimately gets there too. So.
Well, and maybe everybody knows this, maybe they don't, but the European rules are if you want to sell there. So there's a lot of US firms that also need to be aware of
You
this.
can't raise money next year without it. So it's going to be important. No, I know. It's getting back to my earlier comment. It's still early. It doesn't have a lot of teeth, but it's certainly going to force the change of there's a lot of us that are registered investment advisors. There's stuff we do in the firm now because we're registered investment advisors. Do we want to? I don't know, but if we do it, right? Same thing's going to happen with climate as it relates to European investors.
And kind of getting at the question we had earlier and your question about measurement, are we seeing any convergence? I feel like a lot of people don't want to get started because, well, this one might go away and this other, I feel like there's been some, I've seen it more maybe on the impact side, but are you guys seeing any hopeful signs that there is going to be a standard in terms of what to measure and what to report? And you can say no, but I'm just curious if there's any hope.
Go to James's website.
Out of scope. It's out of scope 3 for us. I mean, because we're early stage venture, we do our own public ESG report called the World Positive Report. We publish it every year at the end of the year, and it's very bespoke. We do storytelling about the environmental and social and positive governance in our portfolio companies, but each chapter, each page is specific to that company and that industry. It's almost the opposite of an ESG rubric where you're trying to normalize every company. We think that's fundamentally wrong for early stage. Now, again, at later stage, growth equity, public equities, we think there will be, and we're already starting to see, and Emily talked about scope 1, scope 2, scope 3 greenhouse gas emissions. That and DEI metrics are probably the two most measurable. I think in the governance area, things in the social area, things about supply chain, fair wage labor in the supply chain of a company, those are really important for large public companies. They're harder to measure. People are still trying to figure it out, but we're not spending a lot of time there because we're early stage. So it's kind of later for our companies. We're trying to prepare them so that as they grow, they'll have the right DNA in place to start to build out that measurement.
Yeah, I don't see right now a lot of convergence. I think we're still in the early days, the third inning, or whatever the analogy is. But I think that in order to perhaps get more scale and adoption, I mean, we publish also a report. I look at 30 different kind of indicators for 500. I think that's too many. I think, I'm not sure what the data really tells us right now. So just collecting data for the sake of collecting data, also I see quite a lot of, and I guess that's the fear that it becomes a checklist exercise. And I think there's a need for probably convergence of having this kind of minimum viable sort of framework, if you will, that can then be adapted as a company grows and as they evolve. And I think that's what needs to be focused on next. And that's some of the work that I'm going to do with ESG for VC.
Other questions from the crowd? Yes.
Hi, a question for the panel.
Here comes a mic.
Can we talk about accountability? Question for David. You know, every quarter we get financials from the portfolio companies. Do I go through ESG policies? Do I go through a checklist with them every quarter, every year? Do I do it with a two-man science team versus, you know, a 500 employee company? Where do you draw the line, and how does that impact the back office?
So I'll kind of start so the intention of this mission is to get the capital measurements all the way downstream to the labor force that's implementing whatever you're doing. We're right now at the very front of that, and we're just measuring kind of capital allocation metrics. But that's kind of where the industry is. James has got some stuff that's helping entrepreneurs get organized. As far as our stuff today, as an LP, it's very much at that high level. Do you care about it? What are you doing? Tell us about some of the things you're measuring. I don't think you would need to do it quarterly. I could think you could probably think about it annually, but I also think if you get your companies and those metrics, maybe there's 3 or 4 of them that you're starting to track as they get off the ground going, it should be easy for them to keep track of it, you know, especially the diversity of employees and things of that nature.
I would add to that what we do, is first to we do it on an annual basis. What I do is when companies fill out their questionnaire, I'm kind of looking for, do you have sort of any kind of non-discrimination policies in place? How are you thinking about ethical tech? Is it, you know, part of your integrated into your product development process? I'm asking these kinds of questions so that I can then kind of flag where the companies are, and I can see how many employees they have. What does the diversity mix look like? And then for those companies where we're putting in follow-on capital, I have conversations with all the management teams. If I think that there's okay, there are 10 people and there's no women on the team, how are we going to work together to help you kind of resolve that in the next year? And so that's the kind of approach I think that is needed. There's maybe a pillar of 6 different categories of things that you could look at. And then it becomes on a case-by-case basis. In the instance of 500, we have, I think we've invested in 200-300 companies a year. So if you can imagine, there's quite a lot of data that I'm collecting from these companies, and then I'm having conversations one-on-one with them, and they're operating in different global markets at different stages of development. And there was 2 of us managing a lot of it. But we did have the buy-in from general counsel. We had the buy-in from the managing partners and a lot of the fund managers. And so we also are an accelerator, so it helps to kind of streamline. We know how to scale some of these things. But it's a case-by-case basis.
I would just recommend that for those of you that are investors, when you work with your founders, think about progress, not perfection. This is, it's so hard to be a startup founder, and, on the topic of ESG, no matter how motivated they are, they're balancing a lot of different priorities with limited resources. You want to help them make progress. You want to celebrate that progress. You don't want to just critique them for lack of perfection. So I think there's some humility that's required as well, to just remember that this is like one of 1,000 things that a company needs to do to survive and thrive.
Excellent. Well, let's do one more question, and then we'll take a short break. Way in the back. I think I saw your hand earlier. Oh, sorry.
It's okay. We have not yet found an equitable hand-raising audience questionnaire system. Yeah.
Hi, Sudar Yao from Lucid Capitalism. We're an advisor to VC funds on climate change and social justice. My question is around the current market that we're in. It feels like in the last few months, the power dynamic between LPs and GPs has changed completely. I'd love to hear from each of the panelists on how ESG is meeting this moment or not on this market? Is it helping you get in front of founders that you weren't able to before? Is it helping you with your term sheets? Are you bringing it into your LPAs? I'm curious, in this environment where capital is so constrained now, what does that mean for your ESG strategy?
Do you guys all hear that?
So no, we didn't, because, but we'll try. I think you're trying to ask where in the current market environment, if ESG is really part of the dialogue
Well, I think she's
around
saying there's
investing and from LPs.
Yeah, and they're right now LPs maybe have slowed the taps a bit. And so
Yeah.
if GPs
So-
are fighting a little harder, what are they doing on an ESG front to meet that?
So the big topic today, as far as LPs are concerned, is balance sheet, especially with the public securities declining so much, especially in the fixed income side. I think it's the first time in 40 years that the fixed income side of the balance sheet is actually impacting people's ability to allocate. It's typically been the equity side of the balance sheet. So this is a new thing for everybody that's under 60 that's investing, which is most of the world. And so a lot of people are trying to figure out what to do. So that's one item. The other item is if I have allocation to venture capital, do I want to spend it now or do I want to spend it later? And then, the ESG is kind of a variable that's in addition to, as opposed to driving those decisions today, because the balance sheet equation is still sort of ever present in the investment committee and at the CIO level, I guess is a nice way to think about it.
Have you been fundraising lately, James, that you have some current info?
Well, in end of Q1, we raised our fourth core fund and our second opportunity fund. So we, through a lot of luck, we raised almost $500 million of new capital before, or kind of just before the big downward slope in the market. So I don't have like current front lines fundraising, but I do talk to other managers that are out there, and capital is still flowing from venture went from a boutique tiny slice to a global phenomenon. And so I think if you zoom out the satellite view, venture capital is this unbelievable new innovation driver that's so important. And there just continues to be interest because that's where the alpha is
Perceived.
But in your
perceived to be generated.
fundraising wandering, which is really to your question, is ESG a component of that?
Yeah, for ESG, I mean, I'm probably the worst person to answer that question because it's what we do. And when we started, we had to ban the I word and really show performance and show we had to really fit into mainstream core funds. And now we have LPs showing up at our door saying, hey, our family offices and sources of capital want an ESG specific fund. We'd love to get access to Obvious Ventures for that. That did not happen 8 years ago. So we're seeing a rising tide of incoming interest for ESG.
I believe it. Tracy?
Yeah, I think what I witnessed at 500 was there was an increase, certainly in the due diligence questionnaires that had an ESG sort of component. And I think, as was mentioned, UNPRI were in the process of developing something that's specific to venture, but it's still, at the stage where it's like, do you have something? Okay, you don't. Why not? Will you put something in place in the next 12 to 18 months kind of question? So I don't see it as playing a really significant role in fundraising yet.
Okay. Well, please join me in thanking the panel.
My name's Miriam Hawk. I'm the Executive Director of Venture Forward. Venture Forward was launched by NVCA, the National Venture Capital Association, about 2 years ago. And our primary focus is around diversity, equity, and inclusion, and seeing a more diverse industry, specifically as it relates to the investor base, because investors do have such an important role and have a lot of power in this industry. We also focus on diversity through an intersectional lens. So very much focused on thinking about gender, race, ethnicity, as well as geography, as we all know, because so much of our industry really is concentrated in 3 metro areas, 3 states. And so that's really the lens through which we think about diversity. When we were putting together this session and this program, one of the big things we wanted to do, and it's in the title here, which is, we want to move beyond just like talking about ESG, just talking about D&I, like, yeah, we all get it's important, right? Like, but we want to take the conversation a little bit further. And we all know what the stats are when it relates to DE&I. We're not where we need to be as an industry. Yes, there's been some progress, but it's been slow, it's been uneven. And so I'm hoping with this great group of industry experts, we'll be able to uncover some, I think, really helpful insights, perspectives, takeaways that, again, that you all can kind of walk away with some excitement and some momentum to take back to your organization. So with that, I want to turn it over to our guests here, and you can see from here, you know, what their titles are and what their organizations and affiliations are, but I don't know that it's immediately clear what their specific focus is on DE&I as it relates to their organization. So I want them to, you know, just kind of briefly do an intro and just let us know, like, what is the hat that you're wearing today in terms of like your perspective on this discussion on DE&I. I want to know what your DE&I strategy is specifically, and what is the motivation behind that strategy. So Elliot, I'll just start with you and go down the line.
I'm Elliot. Good morning, everyone. I lead the growth equity practice at Bessemer Venture Partners here in San Francisco. I've been in venture capital. I'm in my 17th year, so I've been doing this a really long time. Of course, I'm Black. Everyone can see that. And because of that, my experience in terms of, I like to think about it actually as ED&I, because I think if you put the D first, you're missing the point. And I'll talk about kind of the role I play. I am the shadow ED&I lead at the firm. And the reason is, as the Black partner, I'm going to do this anyways. But what I actually need is one of my non-Black or non-female partners to step up and lead this charge. The reason why I think equity should come first in these conversations is, I'll tie this point to the journey that we've been on at Bessemer. So it's all about equitable experiences, and that's full stack. It has to start with economics, decision-making, team building, and how we manage the firm. That's my view, and it's now really the view of the firm. And why I think equity is so important is there's a great company out of Toronto called Diversio. They've raised their Series A. I used to be at a firm called Georgian Partners in Toronto, and I brought them in. They're friends of mine, and we did a full study across the entire firm. And what we found was, particularly women and people of color were not having equitable experiences at the firm. There's only been 2 days in my career where I couldn't eat, and this was one of them. Because when they did the exhaustive survey and they showed us the results, you can actually toggle it by age, demographic, which office. And as someone who lead at that time a 100% diverse team, I was sick to know that my team was having a different experience than their peers that were part of the dominant group. So I think, again, you have to start with equity, because if you only diversify, I think, or if that's where you start, you're going to end up with what I call diversity theater. We're going to have more people that look like me or look like some other people on the panel or in the crowd. But if they're not having equitable experience from the top down throughout their entire journey at your firm, they're going to leave, or they're going to end up cementing those Diversio results that we got back. And then lastly, after you figure out equity, you can then bring people into that framework and then start to include them in the next generation of experience at your firm. So I know that's a little bit of a weird open, but I don't think it's possible to play a unique role inside of your firm or the industry if you don't think about it that way. So I'm the shadow ED&I officer at the firm, but I don't have an official title.
Johannes, what about you? What's the hat that you're wearing?
Yeah, thanks a lot for having me. I'm going to play two different roles depending on what is needed. I'm an academic with one hat. I'm writing a book specifically on DEI and venture capital that's hopefully coming out next month already. So I've interviewed, for that project in particular, I've interviewed 80 LPs and GPs around the world, trying to figure out what works to exactly the question that Miriam started with, rather than the stats and all the pledges and promises that people are making. And I think we should talk a little bit about stats in a second, but we get to that. And my second hat, I lead an organization together with Hannah called Venture ESG, which relates to what we saw in the first panel, which is ultimately a broader conversation about ESG, and I've heard many people say the opposite, but I think the right way of thinking about this is DEI is part of ESG, or EDI is part of ESG. And I fully agree with Elliot, which is why I hosted a panel with two white men in a similar setup recently on DEI and venture capital. This is not a conversation that is to be had by Black investors or Black LPs and women only, right? I think it takes everyone to work together, right? The inclusion point that Elliot made, I think is very, very important.
Wow, both of you just stole my thunder. My panelists are brilliant human beings. Hey everyone, I am Rachel Williams. I am a senior advisor with Norwest Venture Partners. That is the hat that I am wearing today. If you check my LinkedIn though, you'll probably see that I'm also Chief Diversity Officer for the Motley Fool, and I've been at Google X and blah, blah, blah. But what I will say in terms of this EDI, DEI, DEIB, if you want to go there, or JEDI, JEDI. Anyone heard of that one? Justice, equity, right? Is that inclusion is probably for me the most important. I appreciate the equity and understanding where some are advantaged and some are disadvantaged in our society and how that plays out in our world. But I think inclusion is where most firms can probably start their work, because I don't think we've been very intentional about that. And what I will say, Norwest has been very intentional about that. First step is to bring in someone who is an expert in doing this work. So I call myself a humble expert because I know that I'm on a journey just as we all are. I don't have it all figured out, but I have put in the 10,000 hours required to be an expert. So I'm going to go ahead and say that I'm an expert, but I'm humbly on a journey in learning about all of this as well. And they brought me in as an advisor so that someone doesn't have to do the shadow work, so that to help kind of steer the ship, to bring in the expertise that I've learned from failures at other companies like Yelp, like Google, like, list goes on and on. But so much learnings, and I think that's probably one of the things I would encourage any VC, PE, social impact, is to bring in an advisor, whether it's just on a consulting gig, whether it's full-time, whether it's an ongoing advisorship, because you need someone who has kind of been in the trenches and done the work to help you steer the ship.
All right, great. Thank you to my panelists. I know I'm the least interesting person on the stage here, if only because of my shoes. But my name is Jeff Nasser. I'm the Deputy CIO at Strategic Investment Group. Strategic is an outsourced chief investment office, so you can think of us as an investment team for hire for institutions that don't want to build one in-house. And so we work with a really diversified client base representing endowments, foundations, pension funds, and health systems on crafting the optimal portfolio for them. We have a very long history of back really since our inception in the late 80s of backing emerging managers, backing diverse managers. And so that's been a really, really important part of our DNA. As far as my role, so you can probably tell, my role is sort of the limited partner kind of view on the panel, and happy to contribute in that way. Our diversity philosophy, I think, goes back to many, many years ago, and the decision that diverse teams really make the best decisions. There's research that proves that. That's a long-held belief that we have had. And so if we are going to be a top investment office for our clients, if we are going to hire the very best managers out there, DE&I needs to be an integral piece of our entire investment philosophy. And as far as who kind of pushes us there and makes us better, so a big piece of what we do for some clients is really defined strictly from a risk and return perspective. We're looking to optimize for their return objectives. But for another set of our clients, really aligning their investment portfolios with their missions is a critical piece of what we aim to help them do. That might be for a piece of their portfolio, that might be for their entire portfolio, and that can materialize in many ways. So either from ESG, either from DE&I for impact. And so again, one of the most exciting things that I get to do in my role is working with our clients on that piece of their portfolio. So excited to be here.
So Johannes, I want to turn to you because you have all this experience with the venture ESG side of things, and we just had a panel talking more about the ESG level. And oftentimes, I think in our industry, DE&I and ESG get used a lot, very synonymously. And if anything, I think DE&I, those letters have been maybe more in the normal vocabulary than ESG. So could you help set this context of how does DE&I align, and what's the relationship with that from an ESG perspective, just like at a high level?
Yeah, I mean, as I alluded to, I think it's important to have a moment of considering what the history of both of these terms are in venture capital. I think DEI has been a concept, and whether it's DEI or DNI.
We don't have to keep doing
exactly.
it.
No, it's
a me thing. I'll do it. You guys don't.
But it has changed, right? Because it used to be D that people talk about, then it became DNI, and then people talk about, as you were saying, all kinds of different things. But that has been a thing, and your first report at NVCA came out in 2016. Say 6-7 years or so. It's been on the agenda. It's been bluntly looked at, and we've been trying to get data, and I think, again, we should make that point in a second, while ESG is much younger. When I started writing about ESG impact, to use the I word, 2-3 years ago, I wrote a TechCrunch piece in 2019, and I spoke to the kind of regular roster of Silicon Valley folks while I was here, and they were all like, oh, no, we don't want to do impact. We don't have anything to do with impact because it means concessional returns, and we don't know what ESG means. In other words, the DEI conversation actually precedes ESG. And I think what we're seeing now, and this is reasons that were alluded to in the earlier panel, European regulation so far, the SEC is trying to come up with something, and we'll see where that goes. It might only be focused on the E to begin with, and I think that's important to consider as well, because that might mean the S isn't, which is where DEI fits, isn't going to be strongly regulated, at least. So regulation swapping over that then has an effect on the LPs, and that has an effect on all the GPs as soon as they're raising in Europe, right? So for the last 2 years, and that's how Venture ESG came about, we've been seeing more and more managers being concerned about ESG, including DEI, because if you're looking at SFDR, which is the Sustainable Finance Disclosure Regulation in Europe, there's a very strong DEI angle in that. In other words, the regulators are now demanding data and disclosures and ultimately thinking about diversity and inclusion from Europe. That's swapping over. I think that's the point where we're at, with the unfortunate add-on, despite having spoken about diversity and inclusion and having statistics, collecting data, nothing has really changed on the level of check writers. And I think, again, yes, we all know the statistics, but it's important to look at it again and again and again to see the 15% of female GPs has stayed flat in the last 5 years. In fact, the money that goes into the hands of female founders and into the hands of black founders, as far as we know, because the stats are very bad, has fallen, right? So whatever efforts have been made, they haven't really gone very, very far.
So I want to get into a little bit of real talk, and I forget who asked the question earlier, which was around accountability. And I think that, you know, we have years of data and just what we know is the industry, and we're not where we need to be. But at the end of the day, we need to understand like who's accountable, either from an industry perspective and also within an organization. And oftentimes, you know, it does come back to sort of who are the allocators of capital, and where does things sort of start at the top of the capital chain, if you will. And so, Jeff, you're our, you know, bring the LP perspective here, and just, I guess, want to better understand like how you view accountability when it comes to, you know, setting DEI goals and also just executing on that strategy, because both of those are, I think, very important. It's not just a matter of having the strategy or the goals. You kind of have to have both, but then there's this level of accountability.
Yeah, so I think that every organization needs to have a DE&I strategy and accountability baked into the organization. That's a key. If they want anything to get done, they need to take accountability for it. At Strategic, we think of our DE&I strategy really on 3 layers. So first, internally, our own firm. Second, in the investments that we make and the firms that we back. And then lastly, in our community. And we really think of each one of those 3 elements as being a critical leg of the stool. And if you neglect any one of those, the other 2 don't perform as well or are not optimized. For the purposes of your question, Mariam, I think, and the focus of this room is really on that, our investments piece. And so we have long thought of ourselves as really valuing diverse teams and valuing team culture as part of our due diligence process, but we had never really taken accountability for that by measuring it. And so several years ago, we went on an initiative to do that across our existing manager base, so different from the prospective managers that are not in our portfolio, and went through a really rigorous effort to ask a lot of qualitative questions. And this is based on, we initially based it on a survey from a questionnaire from the CFA Institute, for those of you that are familiar. There's a lot of qualitative questions, there's a lot of quantitative questions to really get some metrics and put some meat on the bone, really understand everything that was ongoing in our portfolio. What we do with the results of that are really try to shine a light on our managers. So first, we report back to our clients. We think it's a catalyst for them to be more concerned about what's going on in their portfolio. We also engage with our managers, so we're able to highlight best practices across the portfolio for managers of different sizes on diversity practices broadly, as well as diversity metrics. And now that we have a time series of data, we're able to engage with them on actually making progress against their objectives if they have them. All of this is so important because the existing managers of today are the spin-out groups of tomorrow, and hopefully the diverse-led managers of tomorrow that we have the opportunity to invest with going forward. So for that subset, for future investments, again, needed to do a better job of tracking this. So several years ago, really started to dig in. We have a DE&I database tracking all the diverse managers. We have around 1,000 managers in that right now that we are looking at across all asset classes, so not just venture capital. And we're attending conferences like this. We're getting the word out, making sure that we're turning over every stone and hoping to get the very best of those groups inside our portfolio. I will say, again, for our typical mandates, it sort of is, we have clients that, where we're working on an explicit diverse manager sleeve that we think is just sort of allows us greater latitude to get past some of the traditional issues that can complicate the process of hiring emerging managers, broadly speaking, that are often even more compounded for underrepresented managers, managers from underrepresented communities.
Great. And Elliot, since Bessemer is been around for decades, a marquee VC name when you sort of think about firms out there, how often does DE&I come up in meetings? Like, how often are you thinking about it from just your day-to-day of really being the investor to actually talking about DE&I amongst the partnership and at team meetings?
Yeah, the short answer is not enough. I actually want to tie 2 points that you both made and then directly answer your question. One thing that's really important to say a Bessemer or a quote unquote class or kind of size of fund like Bessemer are the spin out funds of tomorrow. One of the things that I think we keep missing by putting diversity first is if we only measure diversity of the fund or of the firm or of the partnership, but don't measure the equitable experiences of the people at the fund, they'll never actually spin out because they can't build a track record. They can't make decisions. They don't serve on board. So now they're non-referenceable. If I think about my career, it's probably 2016. I joined a board of one of the senior founding partners of a very iconic Sand Hill Road firm. And we went to a closing dinner. We had sold this entrepreneur's company. We went to the same restaurant where we were putting the band back together for his second company. And I always open at board dinners about who I am and my values and what I care about, which is obviously this topic. And he said to me, hey, would you mind taking a ride back to Sand Hill with me? I said, yeah, I'm happy to. He had had a couple of drinks. And he said, I got to be honest, I really respect what you're doing, but let me tell you the truth about what's happening in venture capital. He said, there's about 10 of us. We've been in the space 20, 30 years apiece. And we set the ideas and the language and the terms of what's happening. And he said, to be honest, we just decided 5 years ago, we're going to name everyone a partner because our LPs are only tracking diversity. So it allows people to then put on a chart, well, look at the 10 firms now on Sand Hill Road. They're all way more diverse than they used to be. Look at all the female partners they have. Look at all the Black and Latinx partners they have. But if you actually did an equity measurement, it'd be zero change. And many of the women that work at these firms struggle to leave. Many of the investors or couples struggle to leave because then when they have that same conversation with you, there's no one-to-one matching. So I don't mean to go back to the previous topic, but I don't want to overlook that because it's so important. In terms of Bessemer, I would categorize us 4 or 5 years ago as being in that same situation. I can name 4 or 5 different women who left to either start their own funds or become general partners or senior partners in other funds. And that sucks. And when I came in, I said, that can't happen. Like, that cannot happen. So for us, we had to go on a little bit of a journey, and I don't want to linger here, but I would just say before we pass it down the panel, you have to start with the most fundamental question, whether you're an LP, capital allocator, or advising LPs, which is you have to have a conversation on bias. And the question that is really uncomfortable is, do you believe diversifying and making the firm more equitable at the top will hinder returns? And that's a conversation that you have to have, well, I've had to have with my partners. And no one's going to really raise their hand and say, yeah, I think it's going to hinder returns. But you can tell by how quickly and how forcefully they answer that question where they fall on the spectrum. And that's where you start, and that's where you have to go on that journey. And I would say for LPs, you have to ask yourself that same question, in your own IC, that same question, which is, if we actually not just diversified the number of partners on the website, but actually change the power structure within our portfolio and ask about the power structure within our managers' firms, will that hinder or enhance returns? And then you have to walk that journey.
Another interesting website thing that I've noticed firms doing is they've removed titles from the page. So you have to like really click through to figure out, who's actually on the investment team, or, they'll alphabetize the entire team. So it's, you can't clearly see what the investment team makeup is. I think it's because people, especially entrepreneurs and founders, I think are really taking a harder look at who they're taking capital from. I think maybe fund managers as well, although with the market tightening a bit, I think it's harder to be that greedy around who you're going to take capital from. But, with Rachel, you're also at Norwest, another marquee name firm that's been around for decades. I could probably name on 2 hands, of the firms out there that have anyone on their team that has the title diversity, equity, and inclusion on the team page. And so would love to kind of just hear about what that journey has looked like for Norwest to really identify the need to bring on an expert like you, and how you play a role in executing the firm's DE&I goals, and who's accountable.
Yeah. Oh gosh. Okay. That's a mouthful. So first, I don't know what brought them to my table. What I can say is there is a wonderful human being by the name of Chris Snodgrass, and she is one of the principal lead talent recruiters. And, we're all tribal, right? My friends all look like me. Fabulous. And you all, hang around with folks who look like you. But what Chris does in her professional life is ensure that she does not have tribalism. She is out in communities where you wouldn't expect her to be. I've seen her at events and I'm like, what is this very tall, blonde woman doing? Like, she's like, I need to make connections. I need to make sure that the pipeline from the very top is as diverse as it can be, so that when we get down to the rest of the funnel, that we can actually come out on the other end of the hiring with some actual results. And I think, Chris found me years and years ago. And after George Floyd, she remembered our interaction, and she called me up and was like, hey, I need some advice on some things. I'm former head of talent. She's a talent person. And so we were talking, and a couple months later, after our hour-long conversation after George Floyd and kind of what do we do, she was like, do you want to join Norwest? And I was like, as what? Like what? And she created and brought this idea to my table. So I say all that to say is that it really takes each of us inside of our firms or, wherever we are, to figure out what is it in my power, in my role, that I can have impact and make sure I'm being inclusive. I'm looking at equity. I'm making sure that I'm diverse and bringing in marginalized voices. And Chris Snodgrass absolutely did that. So I wish for everyone to have a Chris Snodgrass in your firm. What I would say about the accountability thing, which I think is a great conversation to have, is you have to have a strategy just like you would in any other part of your business. Now, I come from, this is my first kind of venture PE role, traditional public company experience, but you would not have go out and give someone money for marketing and not have an actual strategy on how you're going to apply that money. And the same thing for diversity, equity, inclusion, and belonging. And so at Norwest, the first thing that we did was take the time to build a strategy, and it took weeks. But what I know about the investment world is that we are primed for taking risks. We are primed for looking long term. So this is not going to happen overnight. It's not going to be 2 weeks ROI, anything like that. And I'm like, why are we expecting that out of DEIB when you're not expecting that out of the $250 million you just gave to, Joe Schmo? We're looking long term. So this world is primed in terms of mindset to see DEIB and ESG, for that matter, long term. So we have to stay with it. And staying with it means developing a strategy that is at the intersection of your vision for your firm. So we did some visioning work. No, we're not where we want to be today, but who does Norwest want to be in 5 years, right? 10 years. What do we want being said about us? And that was a couple of weeks exercise. We had some interesting conversations, but we landed on something that is super inspirational for everyone. And now that we have that, we have sub-working groups. So the investing team, they have their charge. What are they going to do? They're doing fund to fund. If you're not in the community already, give money to people who are already in the community. Serena Ventures is definitely in the community. Ulu Ventures, definitely in the community. Chicona, definitely in the community. So if you don't have direct connections, you should be giving your money to funds and supporting those funds who do. We have our hiring and retention. So back to the snakes, Chris Snodgrass. Chris is adamant about making sure that our portfolio companies have access to candidates for diverse board seats. That, like, her pipeline is ridiculous. 250, 350 people that at the ready could join a board that haven't had that opportunity or that access before. And then finally, we're providing that services for our portfolio companies. But what I will say for Norwest, you can't actually give the service to your portfolio companies if you're not living, talking the talk and walking the walk and eating your own dog food. So we were very intentional about making sure that we had a strategy internally that we were going to then share with the portfolio companies on our successes and our wins.
Yeah, just on the topic of strategy, it sounds so fundamental, but it is kind of the, first step one, essentially. And we do a survey every 2 years with Deloitte called the VC Human Capital Survey. We started in 2016, and we have seen just a huge jump in the number of firms that actually now have a strategy. 6 years ago, most of them didn't. And the question is, does it matter? It actually does. We have seen in the survey that firms that have a strategy correlate with more representation amongst investment partners on their team and just broader representation amongst investment professionals. So I think, again, it sounds sort of just so fundamental, but I think it is really kind of step one. Then once you create a strategy, it's about okay, well, great. How do you execute it? And what are the goals that you're setting for yourself? And Johannes, I know you work and talk to a lot of different VC firms. What have you seen to work and what doesn't work?
I mean, perhaps to start with the second bit, there's a propensity in business, this is not venture specific, to do pledges. And they don't work, we know that. And in fact, talking about bias, we also have seen reasonably conclusive research saying unconscious bias trainings don't usually work, which is a lot of the first bits that people have been doing, right? We pledge in our strategy, we say X and promise to do certain things. What we've been hearing a lot, my co-author Erica and me on the work for the diversity book, is we reasonably well need what we want to happen, right? Wire the money and hire the people. It's pretty straightforward. And if the strategy that you're conceiving doesn't include these 2 points, that's likely not going to actually change anything, right? So starting from the very top, you need to figure out possibly even, and I'm not a big friend of quotas, possibly even with a particular number there, right? We want X% of our GPs with equitable access, including to the carry, to not be white men with Stanford degrees, right? So I think even on the level of a strategy, being precise and being concrete makes a massive difference, right? And that again takes us away from the pledge. And perhaps a last point here to talk about the inclusion piece and the equity piece. There's research that has come out recently, less than 3 months ago, which actually says, and this was a big shock for me, and I think a big shock for the kind of overall community concerned about this, more generally, that says the following. If you are a female founder, and again, the assumption is this is because female gender diversity is the easiest to look at. The assumption is this holds true for other groups, underrepresented folks as well. If you're a female founder and you take money from a female VC, you're less likely to get money from anyone else, i.e. you're much less likely to succeed as a founder running a business. In other words, what that takes away is the whole flywheel that we've been building. We need more female GPs investing in female founders. In fact, that finding shows that's not going to help these GPs as much as being properly inclusive, right? It needs people like me to write checks to everyone, not just to people who look like me as well, and to properly work together. I think that is a major finding that is scientific and has been confirmed recently. That takes a little bit of wind away from one of the big flywheels we've been pushing.
Can I touch on that really
gonna-
quickly? I think I don't know how we define whether bias training works. So let's just agree that they can be effective. And the reason why I say that is, as part of our journey at Bessemer, one of the things we had to look at is how are we equitably treating founders that go through our pipeline? And there's so many studies. One of the beauties about technology and investing in software is that companies like Doxin can now give you analytics around how investors like myself engage with even pitch decks. And the data shows that once you get to the team page and you see someone that looks like me, you're out. So you have to imagine if you're on the capital allocator side or an LP side, what does it look like when an investor that looks like me, you might not even get to my thesis. You might not get to my investment track records. You might be out on slide 3 because I'm there. And I went to Morehouse College. Every year, still at the firm, someone asked me, what was it like going to Morehead State? Say, I don't even know what state Morehead State is. So, the statistics have actually gone up. 42.5% of all venture jobs are occupied by 2 schools in Stanford and Harvard. And if you know that's the case in our industry, that bias is obviously perpetuating itself. I often tell my partners, man, if we hire one more person from Harvard or Stanford, how are we going to what's the net ROI on N+1 hire if 70% of the firm comes from these 2 schools? If we're not sourcing great deals out of those 2 pools, then you're all failing. You all suck at this job. It's kind of what I tell people. My last 2 points on this topic, because I think it's so important. From a hiring, retention, and scaling people through the firm, when I came in, I said, look, I get to build out the growth equity practice in my own vision. But I do think it has to do with firm-wide philosophy. Now someone mentioned shoes. I personally think all birds are the worst shoe ever created. I refuse to wear them. I apologize for anyone in the crowd wearing them. But the reason why I mention that is you kind of have to start with values. And we talk about this all the time. And you have to score candidates on values first. As a firm, Bessemer had been around 40 some odd years. We had non-codified values, but we didn't really live them. They weren't written down somewhere. They're now prominently featured after a 2-year journey on our website. The reason that's so important is when those candidates come through, oftentimes you find yourself as a senior partner in the room and someone says, well, Kyle, he looks like he could be a Bessemer venture partner down the road. Well, yeah, there's 22 Kyles in here already, so I'm not surprised by that. But the question is, can Mary or Janelle on my team be partners here? And the only way you can do that, in my philosophy, and now the philosophy I believe of the firm, is to totally strip out the idea of cultural fit and then score candidates on values fit. So you have to codify your values to then score them against a values fit. And then we now score people on something I'm really passionate about is cultural add. Actually want to build the fabric of the firm that then reflects the fabric and the community of the new founders. If you look at founders today, seed and Series A, it's not Kyle anymore. I mean, of course there's Kyles, but the question is, can we extend the fabric, which then allows us to map into the community so the ROI on N+1 hire is much greater than the 25th Stanford or Harvard grad. It's actually people that extend our fabric and DNA into the ecosystem. So I think from how do we live it internally, that was a really tough thing because it's just easy to keep the 40 to 45% of hires the same way, and then you're gonna end up with the same results.
Go ahead, Rachel. I just want to defend Kyle right now. as a leader of inclusivity. One of the things I wanted to touch on, Johannes, that you were mentioning about like what went wrong in this flywheel that we have. What hasn't been working is being exclusive of white men who have the power, the privilege, and the positions. And I think DEI work has focused mainly on underrepresented carrying the weight, doing all of the work, making all of the business cases. But if we actually include those GPs, managing partners, whomever, into the conversation, we're probably going to get a little bit further. Now, granted, they are not in close proximity to the issues. So there we have to be a level of education and empathy to bringing them along. Insert eye roll, I know. But I think what happened with George Floyd showed that to me, with the outpouring of folks reaching out to me personally who was like, I didn't know. Can you teach me? And so that is possible in our world where people just do not know, as mind-blowing as it is. But I'm steeped in it because of my presentation, but they are not. And so I think that work still needs to go on. I think we've taken a little bit of break. There's something called diversity fatigue. Folks have kind of gotten tired after George Floyd, but we need to keep that education going and bringing folks along, especially those who have the privilege, the power, and the position to actually advance this work.
Yeah, I think there's maybe 4 segments of folks in the industry. There's, the current leaders who have, as Rachel, you mentioned, sort of the power today to change their firms. Then there's, folks that are trying to break into the industry that, there are just a lot of barriers to enter the industry. Then there's people who are more junior in the industry that we want to make sure, are set up for success. And then there's the emerging manager world, which I think has brought a lot more, or there's the optimism that it's bringing a lot more diversity into the industry. And Jeff, I know you've done a lot of work around emerging managers. What is your outlook on this space, especially with just obviously the huge influx of emerging managers that have come into the industry over the past few years, going into a downturn? We want to see them successful, but just curious what your outlook is on sort of the diversity as well that they are going to hopefully bring to the broader industry.
Yeah, I mean, I think the short answer is it's a difficult outlook. And I think with the industry experiencing a period of uncertainty, perhaps even more challenging, when you look at the broad emerging manager landscape, it's the same issues that time and time again are hurdles for institutional investors, whether that be size, whether it be track record, whether it be experience working together. And these are all, many of them besides size, are sort of chicken and egg type of issues. It's very, very difficult to solve. And for underrepresented communities, those issues are even more compounded because there's a lack of network and sometimes underrepresentation in existing firms that give them the connections with limited partners and those sorts of things to be able to launch their funds. I think what makes me optimistic at the same time is that I think the broader institutional LP community is starting to think through ways to get more creative to solve some of these issues, at least in some part. So, it's, again, very difficult to back a manager that doesn't have a track record, but are there creative ways to look at that? Like looking at, if there's a single investment person on a new launch firm and the other person's an operator, that immediately broadens the pool of types of managers that you can actually look at and that become investable. From a track record perspective, are there angel investments that you can look at to understand the risk appetite that individual has, their access to deal flow? So, and I think that these types of ideas are becoming more commonplace throughout the institutional investor community. So that's, I think, cause for optimism as well.
So I want to see if we have any questions from the audience. I do have one last question, which I'll pose at the end, but just want to take a question. Yeah, back over here.
Diversity stats at all their funds. And the European funds say, oh, I can't give you that information. It's data privacy restricted. So I'm running into this problem. How do we surmount that? I'm surprised to hear you say they want more diversity data in the regulations.
Yeah, we're trying to figure that out at the very moment. It starts on the level of DEI policy because you basically have to have a policy that looks different in France and in Germany and in the UK and in the US. And I mean, the list goes on and on and on, simply for regulatory reasons. In France, I can't ask. In fact, the word doesn't exist. I can't ask about ethnicity, legally speaking. In Germany, it's not quite as clear, but for various reasons that are historic, that is also a complicated topic of conversation. And how people get around it at the moment is not ideal, but it's not that you can't ask, it's just you can't make it mandatory. So even as an LP, I can't say, but you have to give me these stats in your quarterly reporting. You can still do, which is what Diversity VC does, which is an organization specifically focused on bringing diversity to the VC table that is now also operating here quite a lot. Actually, they work with Diversio on their certification process. In their VC level report, they have stats on gender specifically and on school, which is a kind of reasonably good indication of class, which also people are unwilling to talk about mostly. But they have a non-mandatory extra report on ethnicity. And that is something that anyone can do, right? You basically make it voluntary. And if you are an LP, the likelihood that people will answer is reasonably high, right? I think what we're struggling with going forward even more so is portfolio company level, right? And I think Tracy said this on the panel earlier, what do you then do, right? Now we sit on all of this data, and again, I think the bottom line there is we actually don't have enough and precise enough data yet, particularly for anything that goes beyond gender and ethnicity. But tracking alone isn't helpful, right? We need to then actually put measures in place, right? We have one late-stage investor in our group out of Sweden, Kinnevik. From our knowledge of the industry at Venture ESG, they're the only one that says, we will not follow on if you don't fulfill goal X in whatever, your board diversity within the next Y years, right? That's the type of thing that really bite, right? We are not going to give you money anymore. Right?
Love sticks. But I also think that let's not discount the data at all, because I think, data can feed into your strategy. Who is missing from our portfolio companies? Like, these are things we do need to know. So I think gathering the data is still worthwhile. No matter if it's just even a little bit and it's not the full picture, but it helps with picking the right intervention or initiatives, if you will.
Yeah, over here.
Matthew Chang from Climax Ventures. I just wanted to get your views on if we did a pre-mortem, so looking out 5 or maybe 10 years, and we get to the point where ESG and especially DE&I has been not only integrated but lived to the point where all of us say, hey, we've made a really good progress in the past 10 years. What do you feel are going to be the biggest drivers of that?
I can give you my perspective. I think it's obviously multifaceted, but I think from my perspective, the 2 pillars are pretty clear. So I mentioned I'm in year 17 of my career. I've been Black the whole time. I've been part of this conversation the whole time. And 17 years ago, there was the same talking points. Oh, well, it takes a long time. People have to be groomed. Change comes slowly. Well, I'm pretty sure if we don't do some fundamental things, 17 years from now, we'll be on the same panel talking about a lot of the same things. I think that the most important pillar is actually the LP community, where they really have to, and I've said this already, but they really have to shift away from just sticking on diversity stats, because it's just not real. And then on the venture capital side, we just have to stop being hypocrites. In the same way that we lean on our CEOs and founders to manage their own management teams from a diverse standpoint. It's always so confusing. Even some of my own partners that tweet and blog about look at how great and diverse my portfolio or my management team is, but they don't do the same things inside of their firms. It's so baffling to me. So I think it's a bit of a symbiotic relationship, but it really does start with the LPs, where they have to say, okay, so you've added 22 female partners in the last 5 years, but are any of them part of the general partnership? Are any of them part of the IC? Do any of them serve on boards, and do any of them have economics? I can think of 4 or 5 firms off the top of my head. The answer is no, across all of them. So yes, the numbers might change, but if you go under the hood, they won't. And I think using the term stick, I think LPs or even Chinevec, where I've served boards, those are the only things that will change the behavior because we're unregulated, most of us. I think I'm saying that now as a regulated firm.
Gosh, so many things to say. I think honestly, just seeing the shift in the capital, like we wouldn't. I don't care about disrupting the old school LPs or whomever. I want to see Serena become an LP. I want to see Ulu Ventures become an LP. Like that, like the capital moving, because capitalism is the foundational power system in our country that really kind of keeps sexism and racism and the rest in place. So if we can move that money around, I would say that we're winning. But that's a long time from now. I'm sorry to say that. I think it's going to take us more than 17 years and more than maybe my lifetime.
Well, I know we're out of time, and sorry, but we're going to be hanging out if anyone wants to ask questions after this. But one last quick fire question, bringing it back to the action piece of this conversation, which is you have a group of peers here in the audience. If you could impart, one piece of wisdom, action, takeaway, advice around this that you would want them to leave this room with, what would that be?
I could start to the comment on LPs. I completely appreciate that progress is frustratingly slow and it's not moving quickly enough. But there are, I can definitely say there are more organizations than ever that are listening. They're not yet all moving capital, but there's definitely been forward progress. And again, frustratingly slow, but as I look at my peer sets, the different groups that I speak with, and it's across the interest levels are not just, family offices that were in some ways first movers, not just foundations, endowments, pension funds are all, focused on the issue. So again, I take that as a sign for optimism. So it does seem like there is incremental progress, but there's progress being made.
Yeah, I like the slow thing is interesting because my mother grew up in Jim Crow South. So she literally had to drink at different water fountains designated for her to drink at, sit at back of buses. And so having someone in real time who lived that life and know how far I never had to do that. I don't like, to me, progress, I don't want to put a time on it because it is possible. And it's been 50 years or 70 years of her life. So I don't know. Let's just keep moving, keep marching. What I'm excited or optimistic about is the investment money that is actually landing in the hands of underrepresented and marginalized founders, and also the product inclusion that people are actually creating products. When I started in DEI work, there was no tool, there was no Diversio, there was no nothing. We literally had spreadsheets and we're eyeballing people. Like, do you think he's Black? Do you think she's Black? So the fact that we actually have these tools now in just a matter of the last 10 years is really exciting to me.
Johannes, what about action items, homework?
I think very simple. Put it on the agenda every time, every board meeting, every IC, every partnership meeting. It's not that complicated, right? Sometimes you talk about it for 5 minutes. Sometimes it's a long conversation. It takes weeks. And say no, right? I think that's the second bit. It's great, again, to have the stats. And we need more stats. If I ever made it, or if it seemed like I make a different point. But you need to do something about it, right? If progress hasn't happened in 3-4 funds that an LP has been investing in, say no in Fund 5, right? Because you've been saying that you will say no at one point, hopefully.
I'm going to repeat myself. At every firm I've worked at as a partner, the same question has to be asked on the venture capital side or the GP side as well as the LP side. And if you truly have to create an environment, whether it's you feel comfortable doing it in your own firm or like in our case, you have to bring someone outside to help facilitate the conversation and the journey. You truly have to face the question of, does diversifying your firm or your GP portfolio hinder returns? You really have to ask that question and have an honest series of conversations about it, because I guarantee you there are people in your org that believe, yes, it will. And we're doing it because it feels good, but it's not good business practice. You just have to face that. And on the venture capital side, for those who are investing, you have to have that same conversation in terms of your portfolio. It's always funny when firms invest in their first Black or female founder and they put the entire marketing machine behind getting that word out. And it's their one of 100. You ask yourself, well, why is that? Like, why is this one person getting such a disproportionate amount of coverage? And then if you really go back to that fundamental question, they say, we haven't seen success of female founders in that way. So, we're doing this one-off because it feels good, but we actually, if we had a portfolio of 100 women or 100 underrepresented people, we actually think it would not generate the same or as good enough results. And you just have to walk that journey because nothing will actually change until you do that.
So I have one final shameless plug of an action item, which is I mentioned the human capital survey that we do every 2 years.
Yep.
And we're going to be back out in the market next week. You've probably already started getting some emails about this, but it's really important, and it's how Venture Forward holds itself accountable. It's how I think we as an industry need to hold ourselves accountable in terms of having this data. We last did the survey 2 years ago. A lot has changed in the past 2 years around the conversation around DE&I. And we want to see where we are as an industry. It's one thing to do the pledges, put out a tweet, put social out, be proactive and vocal about it. But if if the data isn't changing as an industry, we're going to be back right up here in a year, giving more homework and assigning out more things and saying like, well, we're in Elliot's 18th year and we still haven't seen change. So that's one shameless plug to please take a look at. And I just want to say a huge thank you to our panelists who I think we learned a lot from.
Thank you.
So that wraps up the main part of the agenda. On behalf of Venture Forward, NVCA, PitchBook, Nasdaq Entrepreneurial Center, just want to say a huge thank you to all of our speakers, to all of you for taking time out of your busy schedule to be here, to really have these important conversations on big issues. For the post-event landing page, actually, if you go to this, use the QR code or just go to the event page, we're going to put up already, I believe there are already a lot of resources that we've talked about or that we have collected. Some of it is hot off the press. James actually put out a piece today. It'll have details on the VC Human Capital Survey, also the reports that Hillary mentioned. So take a look at that. I also want to say just a huge thanks to PitchBook and Nasdaq for their leadership and support in helping us put this program on together. And hopefully this is one of many conversations we'll be having around this because we do not want to lose momentum on these important issues. So with that, that concludes the main part of the program. But